Welcome to the PlanStrongerTV market update for Wednesday, June 17th. Quick look at the numbers. There you see the 2025 total return numbers for the market indices that we track. Slide that over, look at our year-to-date numbers, and strong showing across the board. Some, of course, real standouts with small cap up 19%, foreign stocks almost 16%. Year-to-date, raw numbers, not annualized. So for 5.5 months, wow. Okay, and then bonds basically flat, up about 0.5%. So we're going to dive right into the numbers with Robert. Robert, I want to go beyond these numbers and get into your numbers as it relates to price, import, export pricing, the price paid by the consumer and what they're experiencing. You know, the stock market is doing well. I mean, that's easy to see. Even if you don't tune into our update, you know that, but there is some trade-offs in the economy. There's been concerns about inflation. And so, Robert, let's get to, you know, what everyday Americans are facing, you know, beyond the market and market returns. What are we seeing with the increase in prices in a lot of areas, especially related to energy that we've just dealt with? And I know it's coming down now, but we've dealt with this big spike there, and that affects a lot of the economy as well.
Yeah, so usually when we talk about prices, we're talking about inflation and CPI prices, consumer price index, or PPI, producer price index. But today we're going to be talking about export and import prices. But first, kind of to touch upon what you had said in terms of, you know, the consumers. Of course, you know, energy has spiked up with the conflict in Iran. Knock on wood, Friday, the Strait of Hormuz opens up. We continue to see a decline in energy prices. They're down to $75 per barrel this morning. So a significant decline already, and we're all hoping to see a continued decline in that. So let's kind of back up. Let's do a 35,000 foot view of kind of GDP. There are four main components of GDP. Number one is personal consumption, what consumers spend at the grocery store. That's part of GDP, how much consumers spend. So actually a significant part of GDP. Number two is investments from residents and from businesses. So business, residential investment. Number three is government spending. And number four is, technically it's net exports, which is exports minus imports. So since March, imports, American businesses have been paying a higher price for goods overseas. For example, let me just give you solid numbers. The import prices went up 0.9% for March, a full 2% in April, and then 1.9% in May. That data just came out a few days ago. So year over year, an increase of 6.7%. That's a pretty significant jump year over year, okay? And of course, fuel, energy prices are the main culprit. Now, there's also exports. When American businesses export goods, they get paid for them. Those have also increased. So you have businesses and Americans paying 6.7% overall more for the past year, but for exports, foreigners are paying 11.2% more for our goods being exported. So now this doesn't make the consumer feel good, okay, you know, that's businesses, but just kind of an overall approach, you know, looking at this from 35,000 a 35,000 foot view. I'm getting two-dimensional here. You know, it kind of gives a fuller reflection of our GDP that, yes, consumers are kind of hurting, but at the same time, one component of GDP is doing quite well.
So I want to take that and kind of break down a couple pieces. So number one, we import a lot more than we export.
Yes.
Okay. That's part of the American economy. And so, and as you said, Robert, a big portion of the increase in import prices is oil, fuel related, energy related. As the price of oil and related energy products go down significantly, that then means that we're going to see a better reflection in the GDP numbers.
Correct, especially from the consumer point of
Right,
view,
right.
because when energy comes down, discretionary income increases for Americans, and hopefully they use part of that to stash away for savings, but usually they also use part of that extra money with lower fuel prices to spend, and that will also increase GDP when prices come
Yeah,
down.
yeah, the consumer definitely spends more than it saves when we see that. And GDP, we've been throwing that out there, that's gross domestic product. That's the total value of all goods basically being produced by the United States.
And services, yes.
Okay, and again, we got that little thing with exports and imports, and
Mhm.
that's part of the calculation. So, do you recall? I'll put you on the spot, Robert, and I know you probably have a good idea. During the spike of oil and energy prices, during the run up, and then into the intense part of the war with Iran, where do we see prices get to for West Texas Intermediate? One of the
The
oil.
highest price was 119,
Okay.
but that came down. I think it settled at like 96 on the same day. I think we spoke
But it
about
still
that a
got
week or
almost to
two.
$120 a barrel.
Correct,
And now
yes.
we're at what, 70?
75.
75. So that's a huge decrease. And that is a major input. And I think it's very easy to overlook, and we don't have to get into the too fine of details on this, but energy and oil is in everything. It permeates everything in our economy. So when we see that come down, that really reduces the drag on the consumer. And then to your point, they then have money to spend on other things.
Right.
And that's good for our economy as well.
And if I may say one thing, David mentioned that the United States imports more than we export. Yes, that's called, and when we spend more money buying goods coming in than receiving money with our goods going out, that's called a trade deficit. I have to say, though, that since the beginning of the year, it was for the past year, the trade deficit, the net, the prices have, because we're talking about import-export prices, the prices that we have been receiving through our exports are greater than the prices that these three especially have been receiving through our imports is Mexico, the European Union, and China. So our trade, the export-import prices, the prices that we're receiving is greater than what we're putting out for a comparable amount of goods. So that's really good news. And of course, tariffs are not part of this conversation, but those have served a large component in the import-export and that fourth component of GDP, which is net exports.
So as prices come down, and we see, I think a lot of people, as energy prices go down, expect to see that obviously work its way into the inflation numbers. As we see that, then that tees up the potential not only for better consumer spending or on other things instead of all about the foreign import of energy, although we do a lot of our own domestic energy production. And then that translates to potentially at least interest rates not going up, but maybe at some point they might come down a little bit, which is good for business, good for the consumer, but also just the net effect on the economy. So I'm hearing some positive things here that are going to go on.
Some positive things, and David mentioned interest rates, so I have to say, today Mr. Warsh, our new Federal Reserve Chairman, is going to wrap up the two-day Fed meeting, his first. Expect he's different from Mr. Powell. He has some ideas, different ideas, refreshing ideas, in my opinion, which will most likely, of course, be mischaracterized. So expect a lot of pushback on both what he communicates, both implicitly and explicitly. By the way, rates are probably going to be saying the same today.
Yeah.
But one thing I do like about him is he's obviously the language the Fed uses, the forward guidance, that's all important, and I'm not saying shove it aside, neither does he, but he's been known to put less effect on forward guidance and the communication, the way, and more towards doing the work that the Fed needs to do. So a completely different person with Mr. Warsh coming in, and I'm looking forward to seeing what he has to say at 2 o'clock today. So
Good. Do you think we'll get more just plain language from him, plain spoken, not these hinting or subtleties that sometimes has to be parsed out, or, you got to get out your magnifying glass to look at what the Federal Reserve is saying and how we then read those tea leaves and, and then have some idea of what to expect with the market. You think he's going to be more, the tone will be more blunt?
Explicitly, yes. But one thing he doesn't do is he doesn't believe in the dot plot. So he may not give his dot, the dot corresponding to where he thinks inflation will be in 6 months or 12 months or 3 years out. So that will cause the media to say, oh, he's not being forthright or transparent enough. Quite the opposite. It's that, we're all wrong anyway, and 1 year goes by and it proves us that we were so wrong 1 year ago. Why even do that in the beginning? So again, expect a lot of pushback, but kind of try to see through the noise and listen to what he wants. And we know that when people say things directly, people tend to get discombobulated and kind of freak out a little bit. But for me, that's, yes, I do believe more down to earth, direct. Here's what our mission is as the Fed, and here's what we are going to do.
Okay,
so
I can live with that. Okay, well, that's the wrap for today. We'll continue to monitor the situation. We'll look at what happens with interest rates, the economy. We'll keep track of these prices and energy costs, and we'll come back to you to help you continue to plan stronger.